Hello everyone, Luke McElfresh here. In today's video, we'll be covering the cost of capital. So our learning objectives here today are to be able to determine a firm's cost of debt. We'll also determine a firm's cost of equity capital, both common and preferred. We will also determine a firm's weighted average cost of capital. We will identify some of the pitfalls associated with a firm's overall cost of capital and what to do about them. So when is it appropriate to utilize cost of capital in your capital budgeting analysis? And then lastly, we will use our weighted average cost of capital, we'll discuss what that is, to evaluate a capital budgeting project. So first and foremost, why is cost of capital important? Well, we know that the return earned on assets depends on the risk of those assets. Higher risk, higher return. So as you're taking on an investment or a project that the cash flows are more risky, you will desire or demand a higher return on that investment. This is what is called the risk-return trade-off. Now, the return to an investor is the same as the cost to the company, right? You're going to fund your projects with either debt, borrowings. Someone's not going to loan you their funds for nothing. They're going to require a return. Or as an investor, equity capital, you're going to require a return on that investment as well. So these returns are the same as the actual costs to these companies. Now, knowing your cost of capital can then help you determine what your required return is for these capital budgeting projects. It's also important when you are identifying your capital structure, your breakdown of debt versus equity. What's it costing me to raise funds in the form of debt? What is it costing me to raise funds in the form of equity? As the firm overall will try to minimize this cost of capital. So looking at the firm's overall cost of capital, the required return is the same as the appropriate discount rate and is based on the risk of the cash flows. So we interchangeably use the term cost of capital as your required return, right? If it's going to cost you 5% to raise funds, that project better bring in at least 5% in order for it to be advantageous for you to take on that project. So what is the definition of cost of capital? It is the rate of return that the suppliers of capital, either your bondholders, your creditors, your debt holders, or the owners, your shareholders' equity, stockholders' equity. It's what they require as compensation for their contribution of capital. Now, as I mentioned previously, we are going to be using some words interchangeably when we're talking about these opportunities. So whenever we use the term cost of capital, required return, appropriate discount rate, these all represent the same thing. So first, let's figure out how can I estimate the cost of capital for a company, and we'll expand on this and talk about the weighted average cost of capital upcoming. Well, we need to remember, what is capital structure? Capital structure is your breakdown of debt versus equity. When we go through our calculations here, we will assume that the company is trying to maintain this same allocation, so the same percentage of funding being used for debt as they are for equity. Now, to estimate the cost of capital for the firm as the whole, what we'll end up doing, our weighted average cost of capital, we're going to need to be able to find the cost of these different funding sources. So we will then weight these costs to come up with the weighted average cost of capital for the company. And as I just kind of verbally mentioned, this is your weighted average of the different sources of funding, your weighted average cost of capital. So first, let's focus on the cost of debt. The cost of debt is, once again, the required return on the company's debt. We usually are going to focus on the cost of long-term debt, or otherwise known as just your bonds. The required return is best estimated by computing the yield to maturity on the existing debt, right? If you remember back in our bond valuation, your yield to maturity is the going rate out in the market based on the bond's price. So this is what investors are requiring to loan funds at this point in time on debt obligations of similar features and characteristics. You can also use estimates of the current rates based on the bond rating and what we expect our bond rating to be when we issue new debt. This is called the debt rating approach. But keep in mind that your cost of debt is not the coupon rate. The coupon rate is set at the time the bonds are initially offered, and they look at what other bonds of similar risk, similar features and characteristics, what are they yielding based on their current price, and then they set their bonds coupon equal to that. So when we're looking at what the going rate is at this time, we look at outstanding bonds or our own bonds that have the same features and characteristics of what we're about to issue and see what they are yielding, and then we use that as our cost of debt, our cost of borrowing. So The current cost of debt for a publicly traded bond is once again your yield to maturity calculation. So think back to Chapter 7 if you don't remember how we calculated yield to maturity. But for the current, alternatively, if you're not issuing bonds, if you're looking at long-term bank or private debt, you could just simply call them and see what rate they would charge to identify what the cost of those funding sources are. Now, one thing that you need to keep in mind is that we're always concerned with after-tax cash flows. And so if you remember from your income statement, before you pay taxes, companies get to deduct that interest expense. So we need to understand that that deduction actually decreases our overall cost of this funding source. Remember, again, that your interest expense will reduce how much you owe in taxes. This reduction in taxes reduces your overall cost of debt. So to calculate your return after debt, it is your return pre-tax. This is just going to be that yield to maturity that we'll calculate, multiplied by 1 minus the tax rate. That is called your tax shield. So for example, if you have, for every $1 in interest, if your tax rate is 21%, then it's actually only costing the firm 79 cents to raise funds in the form of debt because of that pre-tax deduction in the interest payments that is used when you use this funding source. Remember that dividends, the cash flows with your stock, are not tax deductible. They come out of after-tax income, come out of your net income, so there is no tax impact on the cost of equity. So let's take a look at an example. You're analyzing the after-tax cost of debt for a firm. You know that the firm's 12-year maturity, so that's how many years remain on this bond, 9.5% semi-annual coupon bonds, those are your interest payments, are selling at a price of $1,200. So this is what is called a premium bond. Bonds sell at a premium when the yield is less than the coupon rate. So I already know when I go into this problem that I'm expecting to get a yield calculation that is below that 9.5%. If these bonds are the only debt outstanding for the firm, what is the after-tax cost of debt if the marginal tax rate is 21%? And then what if the bonds are actually selling at par at $1,000 as opposed to the $1,200 current price in scenario 1? So remember, we solved these on our financial calculator utilizing the time value money row. Your time value money row has 5 inputs. You've got your single cash flow at the beginning of the cash flow stream, your present value. The future value is a single cash flow at the end of the cash flow stream. And then your per period inputs, payment per period, number of periods, and your interest rate per period are those 3 categories there. And in this case, since we do have semi-annual payments, all of our per period inputs will be input on a semi-annual basis. So the current price of the bond is your present value. If I were going to buy this bond today, what is the single lump sum cash flow at the beginning? Now I put a negative there to showcase a cash outflow. Remember that your time value money row always needs to have at least one cash outflow. We try to think of it, or one negative value. We try to think of cash inflows, what you would receive, as positive values. Cash outflows is negative. So our single lump sum cash flow at the beginning is a negative $1,200. If I hold on to this bond until it matures, future value would be $1,000. My payment per period is going to be your semi-annual coupon rate. So 9.5% times $1,000 would be $95 in annual interest, but that's going to be broken down into semi-annual payments, so I would receive $47.50 every 6 months. N represents the number of those payments that remain. 12 years, 2 payments per year, 24 total payments, and we're solving for this discount rate that makes the present value of those future cash flows equal to the price, otherwise known as your yield to maturity. If I bought this bond today at $1,200 and received all cash flows as promised, what yield would I receive on this investment? So when I go ahead and solve for the IY value there, I get a value of 3.5040. But we understand that since everything was input on a semi-annual basis, it's going to give me my output on a semi-annual basis, so I need to multiply this by 2. As yield to maturity is listed as an annualized value. So I get 7.0080. That would be my cost if I was going to issue new bonds today, same features, same characteristics. That is what the going rate on these bonds are currently. So I would have to be paying $70 in interest on any new issuance. That's a cost of raising funds in the form of debt. But that is a pre-tax cost. I need to calculate my return, my required return, or my cost of this debt after tax. So this is going to be calculating the required return or cost of this debt remember, you take your pre-tax rate. I'm going to put this in decimal form. So 0.07008 multiplied by 1 minus my tax rate of 21%. When I do this calculation, I get 0.0554 or 5.54%. That is my cost of debt at this initial $1,200 current market price. So once again, it was below 9.5% like we thought previously, but we also understand that those coupon payments, those debt payments are tax deductible, so our after-tax cost of debt is lower than that initial yield calculation that we did. Now let's do, this we'll say is part one. Now let's do part two, where the price is now selling at par. If the bond's price has gone down, that means interest rates out in the market go in the opposite direction, and that inverse relationship between discount rates and present value of future cash flows. So now in this case, I know that my IY, when I solve for this, is going to be higher than the 7% that we calculated previously. Once again, these are going to be input on a semi-annual basis. In this second calculation, the only thing that changes, I should make that a 2. The only thing that changes then is your initial cash flow. Now the bond is selling for $1,000, still would receive $1,000 at the end if I hold on to it until maturity. Same $47.50, 9.5% coupon divided by 2. Same 24 periods remain, now solving for the IY. I get an IY of a pre-tax basis of 4.75%. However, once again, this is a semi-annual output, so I need to multiply this by 2. My pre-tax cost of debt would be 9.5%. This should make sense because bonds sell at par value when the yield equals the coupon. So hopefully that's supporting what we've already discussed previously in our bond valuation chapter. But now let's calculate the return on this debt after tax. So what is the after-tax cost of debt in this scenario? It is, again, the pre-tax cost in decimal form. I like to always be consistent with inputting my percents and decimals anytime I use a equation. And then I'll multiply this by 1 minus the tax rate. And again, after-tax cost of debt of 0.0751 or 7.51%. And so yes, as our bond price went down, our cost went up in opposite direction. But that is how you go ahead and calculate your cost of this borrowing, this cost of this funding source. Now, if you had multiple types of debt outstanding, you could average these costs of debt, but you also need to consider other types of debt, like fixed rate debt versus floating rate debt, non-rated debt. There's a lot of different variables that are included, but this is the understanding, the overall understanding of how to calculate this cost of borrowing. Now we move into the cost of equity. The cost of equity for a firm is, once again, the weighted average of the cost of the different types of stock that the firm has outstanding. This could be Class A shares, Class B shares, preferred shares. So it's a weighted average to come up with an overall cost of capital for this funding source. And this cost would represent the return that equity investors require on their investments in the firm, right? You're not going to buy stock in a company if you're not going to get some type of return. And we'll talk about these returns here more upcoming. Keep in mind that there are 2 types of equity. You've got your preferred stock, and you also have your common stock. This was discussed back in Chapter 8, so make sure that you refresh yourself on that stock valuation chapter. But once again, your costs of these funding sources are just the required return that investors require in order to purchase shares in these companies. Let's first focus on preferred stock. Remember back in our stock valuation chapter that with preferred stock, they generally pay a constant dividend each period. So what is it called when you receive the same cash flow equally spaced for an infinite time frame? This is called a perpetuity. So we will value these just like a perpetuity when we're calculating the required return on these perpetuities. So yeah, keeping in mind that the dividends are expected to be paid every period forever. So once again, kind of restating what I just said, preferred stock is a perpetuity. So we take our valuation equation for perpetuity and we simply solve for the R component. If you remember, the initial price of a perpetuity is that single level cash flow divided by your required return in decimal form. Now we just rearrange this and solve for that required return. So taking a look at an example here, we've got preferred shares outstanding. We've got annual dividends of $12 and a current share price of $80. And it says, what is the after-tax cost of preferred shares for Crescent? last part. Why? Because your cash flows on these equity securities come from after-tax cash flows, your net income. So there is no tax advantage of the cash flows, so there is no tax deduction. So the after-tax cost of stock is the same as the preferred stock, it's the same as the before-tax cost of stock. So here we've got our equation for the return of this preferred share. We take that constant dividend of $12, we divide it by the current price, and I get a cost of preferred equity of 15%. So if they're going to issue additional preferred shares on this to raise funds for a project, that's what it's going to cost them. That's what investors are requiring in order to purchase these types of equity ownerships. Now let's estimate the cost of common stock. The estimation of common stock is more challenging because of the uncertain nature of the cash flows in terms of their amount and the timing. There are two primary methods: your dividend growth model, your constant growth model, also called your Gordon growth model, or the SML, the security market line, or the capital asset pricing model, similarly called approach. And we'll go into both of these here previously. Let's first do the dividend discount model or the dividend growth model approach. Remember that your price, when you have this constant growth, is equal to the next year's dividend divided by R minus G. We are simply solving for R in this equation, and that will be your required return for investors to purchase these common shares. So solving for that R, we get the return on equity, the cost of equity being the next year's dividend divided by the current price plus G. Remember that this is called your dividend yield. So if you buy this share of stock at that price and receive that cash flow, what type of yield, what type of return do you get in the form of the dividend? And then this is called your capital gains yield. If my stock price is based on the present value of future dividends, if those dividends grow by a certain percentage, then my stock price is also going to grow by that same percentage. I will have that same capital gain. Here's an example. The company just paid a $1.60 dividend. That would be the last year's dividend. We notate that as D sub 0. Our price is always the present value of all future cash flows. If they are expected to increase their dividend by 2% per year into the foreseeable future and their current price is $11.66, what is the cost of common equity for Whitewall? So once again, the return on equity, their cost, is the dividend yield plus your capital gains yield. If you look at what's provided, we can see that we have the current price, we have P sub 0, we have the capital gains yield, but I have D0. I need D sub 1. And I compound it one period at the growth rate. Taking a cash flow today and compounding it to see what its future value amount would be. So I take that $1.60 the last dividend was, and I multiply it by 1 plus the growth rate in decimal. Just raising it to the first power, and I can see that the next year's dividend would be 1.632. Now I have all the information necessary in order to calculate the cost of equity. I take that next year's dividend, I divide it by the current price, and I add that constant growth rate. Notice again, the growth rate is being input in decimal form, not percentage. I get 0.16 or 16%. So investors are requiring a 16% return to purchase common stock shares of this company. That's a cost then to the company in order to raise funds in this particular type of method. Notice also that there is no after-tax adjustment because once again, the cash flows of these stocks, the dividends come in after-tax income. Now in this case, they gave us the growth rate. You can also estimate the growth rate by using historical growth rates, or you can also use analyst forecasts of what they expect future growth rates to be. So here in this example, let's estimate the growth rate for this company. In 2009, they paid a $2 dividend. In 2010, the $2.10 dividend. In 2011, a $2.35 dividend, and so forth. To calculate the rate of return on something or the growth rate in something, it is ending value minus beginning value divided by beginning value. So if I take, I'll do one example. That would be a growth rate here from 2009 to 2010 of 0.05 or 5%. Repeating here for 2010 to 2011, it grew by 11.90% in that second scenario. Third scenario, it grows by 0.0426. Fourth scenario, it grows by 0.0612. Now, if I just want to calculate a simple average, so on average, what did it grow over this 5-year, or looking at 4 different growth rates here, that's called calculating an arithmetic average. That is a simple average where you just add up your inputs and divide by the number of inputs that you have. So I add up these 4 growth rates just to showcase that this is being done first. I'll put some parentheses in there, and I divide it by the number of periods, which is 4, and I get a value of 0.0682 or 6.82%. So on average, just a simple average over the course of this year, the dividend grew by 6.82%. You could also calculate the geometric average, which considers compounding. This will be a lower average, but in this case, we're just looking at, based on their historical dividends, what growth rate can we apply or utilize if they were to continue on average the same growth rate that they have over this 4-year period. 5-year, but you got to have a starting point, so you'll have 4 rates of growth. Advantages of the dividend growth model. It is hopefully rather straightforward to use and also straightforward to understand. Major disadvantages is that the company must pay dividends, right? If the company doesn't pay dividends, you can't use this approach. If the dividends aren't growing at a reasonably constant rate, then your calculation can be misleading. It's also extremely sensitive to estimates in your growth rate, right? If your growth rate increases by 1%, then your cost of equity is going to increase by 1% also, because that growth rate is equal to your capital gains yield, the second component of required return. And it does not explicitly consider the riskiness or the volatility of that security. It's something that the next approach will take into consideration. So that second approach is called the SML approach, the security market line approach. It's also called the capital asset pricing model. And it says that your return, your cost of equity, is equal to your risk-free rate plus the beta of the security. This measures the sensitivity or the volatility of the security relative to the market. So for example, if you have a beta of 1.5, on average, if the market, say some index like the S&P 500, if it goes up by 1% and your beta is 1.5, on average, you go up by 1.5%. Or if you go, the market goes down 1%, you go down 1.5%. You have more market volatility than the market itself. And then you have this market risk premium, the expected return on the market minus the risk-free rate, the premium or the extra return that you earn by taking on the risk of investing in the market. There's also a multi-factor model that can be utilized where you have different betas to different risk factors, but we'll just simplify things here and just do the capital asset pricing model. So here we have decided to estimate the cost of common equity in your shoe business. The risk-free rate on that date is 5.22%. You can have a much greater discussion on what this risk-free rate is in other chapters. And the market risk premium on that date is 7.29%. So the market is providing an extra return in excess, in excess of the risk-free rate of 7.29%, and the beta for your stock is 0.61. So we are less volatile than the market as a whole. What do we expect for our costs? So once again, your return on the equity is equal to the risk-free rate plus the beta of the security multiplied by the market risk premium. Here they gave us a risk-free rate of 5.22%. They told us that the beta was 0.61, and they actually give you this entire market risk premium. They didn't say the extra return on the market. They say the market risk premium. They've already given you that extra, that premium return that the market is providing. And so I have a value here of 0.0729 for a return on the equity of 0.0967 or 9.67%. So here, using the security market line approach, it is telling me that my return or my cost on this equity is 9.67%. Now, if you come up with similar numbers, sorry about this being over top of there, using both the dividend growth model and the SML approach, you could feel good about your estimate. Oftentimes, they're not the same or similar. That constant growth assumes that dividend growth forever. And with your SML approach, it avoids taxes, transaction costs, other market imperfections. But at the end of the day, there is no perfect method for calculating the cost of equity. These are just two different methods that can be utilized to try to identify what the cost is to raise funds in the form of these ownership claims. Advantage of the capital asset pricing model is it does explicitly adjust for systematic risk. Remember that this is your market risk that just is inherently there by investing in the market. And it works with companies that do not offer dividends or whose dividends do not exhibit constant growth. Disadvantages: you have to estimate the expected market risk premium, which does vary over time. You also have to estimate beta, which varies over time. And it's still relying on the past, so looking at volatility in the past to get that beta value, or looking at the market risk premium from the past and trying to predict what it will be. So it's still relying on the past to predict what's going to happen in the future. So now let's put it all together for the cost of equity. Suppose our company has a beta of 1.5, so it's more volatile than the market. The market risk premium is expected to be 9%. So once again, they've given you that parenthesis part, and we have our risk-free rate is 6%. We have used analyst estimates to determine that the market believes your dividends will grow at 6% per year, and the last dividend was $2. So that is D sub 0, a cash flow in the past. And our stock is currently selling for $15.65. What is your cost of equity using both approaches? So using the dividend growth model, the constant growth model, the Gordon growth model, they all represent the same thing. We know that our cost of equity is equal to two yields, the dividend yield plus the capital gains yield. Once again, looking at what's provided, we have the current price. Current price is $15.65. We have the growth rate of 6%, but they gave us D0. I need to first solve for D sub 1. So to solve for D sub 1, I take the D sub 0 that I know and compound it one period at that constant growth rate. D sub 0 was $2. We multiply that by 1 plus the 6% growth rate, and I find out that my next year's dividend would end up being $2.06, which I would then, let's plug that into my equation now. That's not right, 212. Drew a little blank there. So now we get our return on equity to be that next year's dividend of $2.12 divided by the current price of $15.65 plus that capital gains yield of 6%, our growth rate, and we get a cost of equity using the dividend growth model of 0.1955 or 19.55%. Now let's use the SML approach, the CAPM, where your cost of equity is equal to the risk-free rate plus the beta of the security multiplied by the market risk premium, the expected return of the security minus the risk-free rate plugging in our values, we see that we do have a risk-free rate of 6% plus our beta of 1.5. And then once again, they have given us the market risk premium of 9%. And in this approach, I get an expected return of 0.1950 or 19.50%. So we do notice in this scenario that we do have very similar costs of equity using both the dividend growth model and the constant growth model or the SML approach, but this is most likely by chance. So what method should you use? Well, most people use the SML approach to estimate the cost of equity if the result is going to be used in the discount rate for evaluating a project. Why? Primarily because it takes into account systematic risk that impacts the market as a whole. Other models leave this particular component out, and this systematic risk is an important variable because it's unknown, it's unforeseen, and for that reason, it can often not be completely mitigated. So the CAPM approach is often used because it does explicitly consider the amount of market risk that a company has. So these are how the different costs are calculated, both the cost of debt, your yield to maturity calculation of what the current bonds of similar features and characteristics are offering, and then our cost of preferred stock, treated as a perpetuity, solving for R, and also your cost of equity, both using the dividend growth model and the security market line or CAPM approach. Well, how do I now get this weighted average cost of capital? What's the definition? It is a weighted average of the after-tax required returns. Again, that's just for debt. A weighted average of the after-tax required rates of return on a company's common stock, preferred stock, and long-term debt. You can think of WACC, that's how you say WACC. You can think of the WACC as the minimum return a company needs to earn in order to satisfy all of its investors. We can use our individual cost of capital that you have computed to get this average cost of capital for the firm. And then this average is the required return on the firm's assets based on the market's perception of the risks of those assets. Those risks including default risk, liquidity risk, volatility, market risk, all of these different types of risk sources. Then the weights are going to be determined by how much of each type of financing is used. So in our entire capital structure, what percentage of our funding is debt, what percentage of our funding is preferred stock, what percentage of our funding is common stock. So let's first focus on these weights. Your notation, we have E, D, and V. E for equity, D for debt. V is the market value of the firm, so the sum of all of their funding sources. In this particular example, for notation, we are not going to be using preferred shares. When we do introduce preferred shares, we'll notate those as a P to represent that funding type. To calculate the weights, you take, first of all, I want to highlight this. Always use market values. Right? You're not going to use book values. We want to use market values. So your weight in equity is your market value of equity divided by your total value. Your weight in debt is the total value of debt divided by the market value. So just what percentage of your overall funding is in the form of debt and in the form of equity. We are excluding our current liabilities. We're just focusing on long-term liabilities when we talk about debt there. If a company were to use a substantial portion of current liabilities to fund their assets, then you would include it, but we will be simplifying it for our purposes and just using the long-term funding. So let's do an example. Suppose you have a market value of equity equal to 500 million, market value of debt to 475. What are the capital structure weights? So step one is to calculate what is our total market value, right? Add the 500 in equity, 475 in debt, and we get a total market value of funding of 975 million. To get the weights, we just do the respective divisions. 500 in equity divided by that total, so 51.28% of our assets are funded with equity, 48.72% then are funded with debt. Now let's look at the equation for calculating the weighted average cost of capital. It is simply going to be the weights multiplied by the cost that we covered previously, and then notice that with debt, we do have that after-tax adjustment. Now, if there were preferred shares, we would also have that component in our equation as well. So it all depends on whether or not this is for no preferred here up top. This is with preferred, our second equation. Simplified example here. We've got Mike's t-shirts. They've got debt claims of 400, equity claims of 600. Cost of debt financing after tax is 11%. Cost of equity is 17%. What is Mike's weighted average cost of capital? So we are using equation 1 here. First thing that we need to do is get our weights. Well, what is the total market value of their funding sources? Well, we've got 400 in debt, 600 in equity for a total funding source amount of $1,000. It's just going to be that 600 market value divided by the total. And since we only have two funding sources, we know that this one has to be 40%. We can confirm by doing the calculation as well. So now that I know what my weights are, I can calculate the weighted average cost of capital, where it's going to be weight in debt multiplied by the cost of, or weight in equity, multiplied by the cost of equity, 17%. Add to that the cost of debt multiplied by its cost. Notice that they've already done the after tax, so they've already given us this entire component there. We wouldn't have to multiply that by 1 minus the tax rate, the tax shield, because they've already given it to us, and they've given it to us at 11%. And so I get a weighted average cost of capital of 0.1460 or 14.60%. That's calculating weighted average cost of capital, kind of throwing all this stuff together. And now we can make it even more complex or more detailed and take a look at another example here. Here we have some equity information, 50 million shares outstanding, $80 market share price, beta of 1.15. They've given us, once again, the market risk premium, so that we don't have to do any of that expected return on the market minus the risk-free rate. They've given us that premium, and we've got a risk-free rate of 5%. We can see that we have $1 billion worth of debt outstanding. We've got a current quote. Remember, bonds are oftentimes quoted as a percentage of face value, so they're selling for 110% of face value. Coupon rate is 9% with semi-annual coupons, 15 years to maturity, tax rate of 21%. Let's put it all together here. Cost of equity. Well, based on the information that they have provided, we don't know dividends, we don't know growth rate, so we have to use the SML approach. So to calculate the cost of equity, it is going to be the risk-free rate plus divided by the market risk premium. Once again, if you need to refresh yourself and go back to the equation, this is our SML approach. And I get a cost of equity of 0.1535 or 15.35%. Now let's do cost of debt. Cost of debt is the yield to maturity based on the current price. Well, we see that the bonds are selling for above par value, 110% of par value. So that means yields must have gone down from that coupon rate of 9%. Whenever bonds sell above par value, that means the yield on those bonds is below what the coupon rate is. Let's prove that. So once again, we've got 5 inputs when we're solving for the cost of debt and solving for that yield to maturity. Again, our per period inputs need to be input based on the frequency of the coupons, which is semi-annual. Present value is the initial price. 110% of $1,000 is $1,100. We're going to list that as a negative value to showcase me buying that bond today, a cash outflow. And then if I hold on to it for 15 years, at the end of the 15th year, that single lump sum cash flow would be $1,000 I receive at maturity. My payment, coupon rate times par value gives me $90 of interest for the year, but distributed in 2 equal payments, so $45 every 6 months. And my number of payments, 15 years remain times 2, so 30 payments are what I would receive. And we're solving for the IY. When I solve for the IY, I get 3.9268. Remember, since this is semi, that output is semi, yields are listed as an annualized value, so I multiply that by 2, and I get a yield to maturity of 7.8537. However, that is pre-tax cost. With debt, you have an after-tax cost of debt, and that's what we're doing in the next bullet. What is the after-tax cost of debt? So to calculate the cost or your return, since return by investors is the cost of the company, just the opposite side of the coin, I take my pre-tax cost of debt, 0.078537, multiplied by 1 minus the tax rate. So again, after-tax cost of debt here of 0.0620, or 6.20%. So what I've done right now is I've calculated the cost that it would cost the company to raise funds in the form of equity and the cost that it would cost them to raise funds in the form of debt. Now let's go and move forward and calculate the weighted average cost of capital. So let's figure out the capital structure weights. First, let's figure out the market value of equity. They've got 50 million shares outstanding at $80 per share for a total market value of equity of $4 billion. Now, they've got $1 billion outstanding, $1 billion in face value outstanding, multiplied by a market price of 110% of par value. So multiplying that by 1.10 would be 110% in percentage form. Or sorry, it would be 110% in decimal form. And so they have 1.1 billion in debt outstanding for a total market value of funding of 4 billion plus 1.1 billion, or a total market value of 5.1 billion. Now we need to get our weights. The weight of equity is the market value divided by the total. So my funding source in equity is 0.78 78.43 or 78.43%. And then my weight in debt, we know is going to add up to that to equal 100%, but we can go ahead and improve this. 1.1 divided by 5.1. I apologize for the small writing here. And we end up getting 0.2157 or 21.57%. And throwing it all together, your weighted average cost of capital is weight of equity, 0.7843, multiplied by its cost, 15.35. Notice here that I am putting this in decimal form. You'll notice if you've watched any of the other videos, this is a constant theme. I try to always do this. That way you don't have to memorize when you can and cannot get by with converting it to a decimal. You just do it all the time. And so let me just highlight once again, we've got weight of equity. You've got weight of debt. Now we're getting a weighted average. So we now need to conclude with our weight of debt of 0.2157 multiplied by our cost of debt, which was after-tax cost of debt, 0.0620. And we come up with a weighted average cost of capital of 0.1338 or 13.38%. And that is the weighted average cost of capital. Calculating the cost of capital of each of the funding sources, then getting the weights of the funding sources in terms of their total funding, and then getting a weighted average of them. Now, just to give you some context here, let's look at a company's Bloomberg shot. In this case, we're going to look at Nike's Bloomberg shot. I just want to give you a application of some of this. Notice that they have their different funding sources. You've got the weights of their different funding sources, so they don't have any preferred shares. Their funding sources are common stock and borrowings. You can get the cost of these different funding sources like we've done previously. Multiply these together, you get the weighted cost. Adding them together, you get their weighted average cost of capital. How do you get those weights? Well, you've got a total amount of investment. Those in terms of equity, 92.3% is their weights. Of their funding sources, you've got your long-term debt being 6.8% of their funding source. We excluded short-term debt in our calculations. Over here, we've got net operating profit. This is essentially their operating income. You've got taxes paid that were made on this operating income. You've got their net operating profit here. So this is like your theoretical income from operations if it had no debt. Here we have their cost of capital as a monetary amount. And then you can get their true economic profit by looking at economic value added. Now notice that they have a return on their invested capital of 19.68%. And then if you subtract their weighted average cost of capital, they get an economic value added spread. So adding that amount in terms of what their returns are relative to what it costs of 9.98%. And so that's just hopefully giving you a little bit of context of where we are here. We first calculated the cost of these funding sources. We then were able to identify the weights of these sources. Again, notice that they use short-term debt in their cost of debt. We just simplified it. You get your weighted average. Adding them together, you get a weighted average cost of capital. So looking at some limitations of using WACC as a discount rate. Oftentimes, a firm can use this cost of capital as your discount rate, your required rate of return when evaluating capital expenditures. As I mentioned previously, there are definitely limitations, but there is no perfect alternative to calculating cost of capital. When is it appropriate to use your weighted average cost of capital as your discount rate? Well, when the project's cash flows have the same amount of systematic risk as the firm as a whole, right? Some projects are going to be more risky or less risky than the firm as a whole, so only if it's the same risk level of the project relative to the firm. And a firm's WACC should be used to evaluate a project only if you're going to use the same financing mix, right? If you're going to use more debt to fund a project, you wouldn't use WACC because it's an incorrect representation of what it's going to cost you. You would tailor it and manipulate your equation, the weighted portion, to represent the way that you're going to fund that project. So just like when you're evaluating the projects and their respective cash flows, this weighted average cost of capital is also going to be kind of an estimate, right? You can adjust these calculations based on the riskiness of the project, and that's one thing that you can do as an alternative. First alternative is you can use a pure play comparable. Try to find a company that operates in the exact same business as what the project that you're evaluating, and then you could use their stock and their required return to estimate the cost of equity or the required return that you must earn on that project. But it's usually not feasible. It's difficult to find a public firm that is only in the business that is represented by the project that you're evaluating, but it is an opportunity or an option. You can also sometimes classify projects into categories based on their systematic risks, and then adjust your cost based on where that project falls in terms of the riskiness of that project. This is called the subjective approach. Typically would have 3 levels: low risk, moderate risk, and high risk. So for example, your cost, your expected return, and your beta, the systematic risk of the project. You could have your weighted average cost of capital there, and then you have different categories that may fall as low risk, moderate, and high risk, where your weighted average cost of capital might be used for your, let me redraw that line. Your weighted average cost of capital may be used for your moderate risk projects, and then you have other projects with higher risk, and then you higher, maybe say you add 6% to your WACC for those types of projects, or you could even have lower risk projects where you would say subtract 4%. So anyway, you have your WACC for projects that are the same type of risk as the company as a whole, but then you adjust it for projects of different risk. And then so this kind of breaks down the possibility of making incorrect decisions, right? If you fall above here, that forecasting risk that was discussed back in chapter 9, here this would be an incorrect rejection of a project when you should have accepted it. And then if it's below that line, what you end up getting is an incorrect acceptance. But anyway, this is discussed more in chapter 9 if you want to look more about it. But this is another alternative to WACC. So let's put it all together to actually evaluate a capital budgeting project. So once again, these are your long-term investments. They're considering investing in a new project. The project requires an initial investment of $500,000 and is expected to generate the following after-tax cash flows. They use their weighted average cost of capital to discount these future cash flows. If you use the previously calculated WACC from our putting it all together equation, or our putting it all together example, in that example, the WACC was 13.38%. What is the net present value of this project? Well, let's go ahead and calculate this. So first thing that we need to do here is input the cash flows into our cash flow function and solve for the net present value. So to solve for the net present value, your CF0 would be your initial cash outflow. So in this case, it's going to be I'm getting my calculator set up here. Your CF0 is your initial cost of the project or the cash flow it's already in present value terms, so $500,000 as a negative value to showcase the cash outflow. CO1 is the year 1 cash flow that needs to be discounted back 1 period. In this case, it is $120,000, and we would be keeping the frequency of this cash flow at 1 since these cash flows are only occurring once consecutively. So I'm just going to skip actually writing that out here. You've got CO2 of $150,000, so $150,000. CO3 of $180,000, CO4 of $200,000, and then CO5 of $250,000. Once I have all these cash flows input, I'm going to hit the NPV button to input my discount rate. I've told the calculator 2 of the 3 characteristics of cash flows: the size, the amount, and the timing when they occur. Now I need to input the discount rate. I hit the NPV button. I'm going to discount all these cash flows at my weighted average cost of capital. So I put in there 13.38. Your calculator knows that that's a decimal, so you input it as a percent. I push the down arrow, I hit compute, and I get a net present value that is equal to $100,482.42. Would they accept this project? Yes, because it has a positive net present value where the present value of these cash inflows exceeds the present value of the cost by over $100,000. Now, the last part is at what discount rate would management be indifferent? Management is indifferent when the net present value equals 0. Well, what is the discount rate that forces NPV to 0? That's solving for the IRR. So now that I've already got my cash flows all input, I'm just going to hit the IRR button and then hit compute, and I get an IRR of 20.42%. So as long as my cost of capital is below that amount, this project's going to have a positive net present value, and they would move forward and accept this project. So hopefully you enjoyed today's video talking about the cost of capital and how it's calculating the cost of our different funding sources, both debt and equity being both preferred and common stock, then focusing on how a weighted average cost of capital is calculated by looking at the weights of those funding sources in relation to the total funding amount. So thanks, have a great day, and I will see you on the next video. Thanks.